Hey everybody. So this is going to be our video on the break-even point. So basically this is going to be the first video in our CVP chapter, so cost, volume, profit. So when we talk about cost, volume, profit, we're going to do a lot of really cool things like talking about how many units do we have to sell to break even, which is this first video. If I have a multi-product company, how many of each of the different types of products should I sell to try and maximize my profits? You can answer questions like, what did dollar sales need to be so that I can achieve an income of, say, $300,000 or an after-tax income of $120,000. So we can answer a lot of really cool things with CVP analysis and the tools that we're going to generate here in this chapter. So the first thing I want to talk about is the break-even point. Now the break-even point is basically the point at which we neither make nor lose money. So basically income, profits will be zero. Basically when we do a break-even analysis, and managerial accounting is again, it's different than financial based accounting. So we're not grouping our expenses in terms of the type of expense, so selling and admin expenses versus cost of goods sold and all that sort of stuff. When we talk about managerial accounting and through a lot of this analysis, we're breaking out our expenses and our based on their behavior, so variable versus fixed. So when we do a break-even analysis, basically what we're trying to achieve, or the number that we're stating, is going to be either the number of units that we have to sell or the dollar sales we have to achieve to cover both our fixed and variable costs. Okay, so you can do it a number of different ways. You can use a mathematical equation, you can use the contribution margin, or a CVP graph. Now we'll be focusing on the contribution margin, and I've got a spreadsheet here. I've got a CVP formula spreadsheet here that's going to be available, and it's got a list of all of the most popular formulas that we will need to calculate over the course of the semester. So we're going to focus on these two right here, the break-even point in units and the break-even point in sales dollars. So effectively what we do is we take, for break-even point in units, we take our fixed costs and we divide it by something called the contribution margin per unit. Now, when you use this formula sheet, the best way that I can offer up for you guys to practice with this is to take this formula sheet and basically every time you're asked to calculate a ratio or calculate something from this sheet, write the formula out. So if it was me, the first thing I would do if I was being asked to calculate the break-even point in units, I would say BE point in units equals fixed costs divided by contribution margin per unit. Then what I would do is I would go back to the question and I would start seeing if the question has given me any of this information. Now most times you'll be given the fixed costs, so you'll be able to fill in the fixed costs, right? But likely what will happen is you'll get to this point here and you'll need contribution margin per unit and you won't have it. So what I do then is I come right back to this formula sheet and I find the formula for contribution margin per unit. Well, that's right up here, contribution margin per unit, which is the unit selling price minus the unit variable cost. Right? It's a really basic calculation, but effectively by writing out these formulas and then just playing fill in the blanks, you should be able to back into any question that I may be asking you. Okay? But anyways, the break-even point, like I said, it's basically the point at which we neither make nor lose money. Okay, and there's two ways to calculate it, as mentioned. Either in a break-even point in the number of units, which is fixed cost minus contribution margin per unit, or you can express that same break-even point in dollar sales. So instead of saying we need to sell 1,500 units, you could sell, our sales need to be $320,000 for us to break even. The way you do the breakdown or the break-even point in dollars is to take your fixed costs and divide it by the contribution margin ratio. That's going to give you the break-even point in dollars. Okay, so two reasonably simple calculations. So what we're going to do right now to kind of solidify this is we're just going to take this information for Vargo Video. Now this company produces DVD players, and you can tell this slide's a bit dated because I don't know that there's many DVD players out there that still cost $500, but whatever, we'll run with it. So we have a unit selling price of $500, we've got variable costs of $300, and we have total monthly fixed costs of $200,000. So the question is, how many units would Vargo Video need to sell just to break even? So we don't want to make money, we're not, and we definitely don't want to lose money, but how many units, what's the bare minimum that we would need to sell to break even? Okay, we're going to do this in units, and then we'll see if we can get through it express it in terms of dollar sales as well. Okay, let's go to Excel to take a look though. Pull it up here. All right. So here's our Vargo video example. The sales price is $500. The variable costs per unit are $300. We've got fixed costs of $200,000. Actually, I should go to this tab. Okay, we've got fixed costs of $200,000. Now the question said, what is the break-even point in units using the above information? Okay, so use that formula sheet. It's asking us for the break-even point in units. So here's my formula. The break-even point equals the fixed costs divided by the contribution margin per unit. Now, again, like I said, just fill in the information, like get the free stuff out of the way. The formula requires us to grab fixed costs. Well, they gave us that number right here. It's $200,000. So I'm just going to plug that in. Right? So my fixed costs are $200,000. Now, what I have to do is I have to divide those fixed costs by my contribution margin per unit, which unfortunately the question has not given me. So what I would do at this point is I would go back to the formula sheet and I would find that formula for contribution margin per unit. And you would see that contribution margin per unit is a function of your sales price minus your variable costs. Okay? So for this Vargo video example, our sales price is $500, our variable costs are $300. So to figure out contribution margin per unit, it's simply $500 minus our $300 in variable costs. So that's a contribution margin of $200. Okay. Now you should remember from what you've read about contribution margin that effectively that contribution margin is used for two things, right? That $200 right there per unit, we use that for two things. One, to cover off our fixed costs, and the second thing is that we want that to contribute towards profit. So that $200 that's left over from every unit we sell, we get to use that to cover off all our fixed costs, and if there's anything left over, then it turns into profit. Okay? But to continue on and answer the question, we're trying to get the break-even point in units. We come back up to that original formula. We needed fixed cost divided by contribution margin per unit. Well, we were missing the contribution margin per unit, but we just calculated it's $200. So the break-even point in units is calculated by taking your $200,000 in fixed costs and dividing it by $200 per unit in contribution margin, which means that to break even, we need to sell 1,000 units. Okay? Again, this is stated in terms of units, not dollars. So if we sell 1,000 units, we will break even. We won't make any money, we won't lose any money, we'll break even. So that's the break-even point in units. Now, you could also express it in sales dollars using the same information. Right? I'm just going to freeze these panes here. Okay. So now let's take a look at this and let's pretend that the question said, hey, what's the break-even point in sales dollars? Well, if you go to your formula sheet, right, the break-even point in sales dollars is your fixed costs divided by your contribution margin ratio. Okay? So we're just going to fill that in. Again, like I recommend writing it out just until you get used to it. You'll be able to fast track this later on when you're more comfortable with it, but to get started, I would say break-even point in dollars equals my fixed cost divided by my contribution margin ratio. So again, just fill in the information that you know. The question gave us fixed costs. They're 200 grand, right? So I'll take $200,000 and I need to divide that by something called the contribution margin ratio, which I don't know. It hasn't been given to me in the question. So what I need to do is, again, go back to the formula sheet, and I know this is a lot of jumping around, but you go back and here's the formula for contribution margin ratio. You take your contribution margin and you divide it by your sales amount, or you can take your contribution margin per unit and divide it by the unit selling price. Okay? So if we head back over to our question, we've got a sales price of $500 per unit, a variable cost of $300 per unit. So my contribution margin per unit is $200. We calculated that in the last little section, right? So I make $200 for every unit that I sell. To get the contribution margin ratio, you just take that $200 and you divide it by what you sell the product for, which in this case is $500. Okay, so 200 divided by 500 ends up being a contribution margin ratio of 40%. Okay? Now I can take that 40% and backfill it into the first ratio or calculation. My fixed costs are 200,000. My my contribution margin ratio is 40%. So therefore, 200,000 divided by 0.4 gives me a break-even point in dollars of $500,000. So if I sell $500,000 worth of these DVDs, I will break even. If I sell anything less than that, I start to lose money. If I sell anything more than that, I make money. That's how it works. That's what the break-even point is. Okay? So use those formula sheets. Now, if you're not given a formula sheet for the test, memorize those formulas, write them out. The more times you write them out, the easier it is to memorize. And then you can just backfill these numbers, and it makes it really, really simple. Okay? There is a second way. Like, let's say you were given a question, and part A to the question said calculate the break-even point in units, and then part B said calculate the break-even point in sales. Right? There's multiple ways to calculate this break-even point in sales. So the first method is what we did here with the formula sheet. Right? We said fixed cost divided by contribution margin ratio, and break-even point was 500 grand. Right? Alternatively, if you already know your break-even point in units, and the second part of the question says, hey, what's the break-even point in sales? Option 2, right? So if I was trying to solve this, option 2 would be to say, okay, what's the break-even point in sales dollars is also effectively equal to the break-even point in units times the unit selling price, right? So if we go back up top, we said the break-even point was 1,000 units, right? That's my break-even point in units. I need to multiply that by the per unit selling price, which is $500 a unit. Right? I sell these DVD players for $500. Okay? So if I take 1,000 units and I multiply it by 500, I just hit my break-even point in sales of 500K. Right? Now, that works awesome and that works great when they've already asked you to calculate the break-even point in units. If they go straight to asking you to calculate the break-even point in dollars, you're doing extra work to go through and calculate the break-even point in units and then convert it to sales using option 2. The best way to prep yourself is to probably know both of these formulas and how to calculate them, both in break-even point in dollars and in units, so that you're good to go. Okay? One last thing that I wanted to mention before I shut this video down, it's something that you should have pulled from the text as you read it, is that contribution margin. You see right here when we calculated the contribution margin per unit, that $200 per unit, right? Now I told you that that goes towards covering your fixed costs and your variable costs, right? The beautiful thing about that contribution margin and understanding what it actually represents is that if you ever get a question that says, okay, so the break-even point is 1,000 units, well, how much would your profit be if you sold 1,050 units, right? So instead of going back all the way through and taking your sales price and multiplying it by 1,050, and taking your variable costs and multiplying them by 1,050, and then subtracting your fixed costs, instead of going through all that, right? If you understand the concept of contribution margin, it streamlines a question like that. So let's say this question was given to you. Part A was calculate the break-even point in units, right? Which we did. It's 1,000 units. Part B was calculate the break-even point in sales dollars, which we did. It was 500,000. Now let's pretend that Part C says, assume that we sell 1,050 units. What would profits be, before tax profits, be at this point? Well, because I understand that this $200 per unit contributes towards fixed costs and profit, what I need to do for Part C, right? So Part C was, what if we sold 1,050 units? What would profit be? Right? Well, effectively, this is what I can do, right? I know that I'm going to sell, the question just told me we're going to sell 1,050 units, right? Okay, so my profit is going to be based on that 1,050 units. The only units that are contributing towards profit are the number of units we sold above the break-even point. So up here in Part 1, we calculated the break-even point was 1,000 units, right? So effectively, we've sold 50 more units than we needed to break even, right? And each one of those 50 units generates a contribution margin of $200 per unit. So to get to my profit at that sales level, all you need to do is take the extra 50 units you sold, multiply it by the 200 bucks per unit that you make in contribution, and you have $10,000 in profit. Right? Now, you could, if you don't get that concept, that's absolutely fine. You can take the longer road and you'll still get to the same answer. So if you were trying to answer part C on a test and you're like, God, I know there's a shortcut, I just can't remember it, skip it. Just do it step by step. And we'll do it right up here with this information at the top, right? I sell 500, each unit I sell generates $500 worth of sales profits, right? So 500 times the 1,050 units we're planning on selling is $525,000 in sales, okay? Based on our conversations from Chapter 2, you know that variable costs per unit, total variable costs move up and down proportionately with volume, right? Which means that we have to take that $300 per unit and multiply it by 1,050 units as well, right? So 525,000 minus 315,000 gives me a contribution margin of $210,000, right? I subtract from that my fixed costs of 200,000, right? And I end up with profit of 210 minus the 200, or 10,000 bucks, right? That $10,000 right there is the exact same $10,000 we just calculated down below. But if you understand the concept of what contribution margin represents and what it covers, you can simply take the difference between what you're selling and the break-even point, multiply it by the contribution margin per unit, and bam, you've got your profit. Okay? So that's it for this vid. We're going to have a few more. I think the next video is going to be about achieving a target net income. So let's move beyond just breaking even and let's try and achieve some type of target net income. Okay? Cheers.